So we're talking about partnership tax liability allocation. Now, the rules for this topic are found in Code Section 752. We know Subchapter K deals with partnership taxation, the 700s. 752 is a specific rule. Now, 752 deals with a few different issues, but one main principle that comes from 752 is that liabilities taken on by partners go into the basis of the partner, of the partnership interest, the outside basis of the partner. Now, why does that matter? There's two reasons. There's two reasons that it matters. Very important reasons. The first deals with losses. As we know, partnerships are flowed through entities. The losses can flow through to the owners. If a partner can take a loss, that's another issue. One of those limitations on losses, there's lots of them, is, okay, well, you have to have enough basis in your partnership interest. All right, well, if we need basis, anything that's going to increase our basis is good. And if liabilities increase basis, hey, this is an important aspect of this is a very important aspect of tax. Okay, this topic. A second issue of why this matters deals with distributions. As we've seen in previous discussions, and we'll also see in later videos, distributions from a partnership to a partner, you can have potential gain to the partner. The higher your basis is, the less chance you're going to have gain. We can understand that. It's a pretty fundamental tax concept. Same thing applies in partnership tax. If you've got a cash distribution, you don't have enough basis in your partnership interest, you're going to have gain. So if you have a higher basis in the partnership interest, guess what? You're going to be able to eliminate gain. Reduce the chance of gain. That's good. So I think I pretty much stressed that, okay, if liabilities are that important for basis and the reasons why, then I've got your attention now on, okay, well, how exactly do we allocate liabilities? Because I want to know, because if I'm representing a partner in a partnership, I want them to get as much as possible, right? Okay. So every year, we're going to complete the analysis we're going to discuss. We're going to basically break up the amount of liabilities the partnership has outstanding, okay? So we're going to complete the analysis each year. So the analysis each year is asking the following question. How is the liability allocated? So how is the liability allocated among the partners in the partnership? The issue is, if a partnership takes on a liability, how is it going to be spread among those partners and their bases to determine the outside basis of each partner? That's the question you're asking each year. So if you have an exam problem, you got a problem in practice, whatever it is, and you're asked about a specific year, it can change from one year to the next based on the economic situation going on. So one year it might be split one way, the next year it could change and be split another way. We're going to see that through our analysis. But that's what you're asking each year. Say, okay, in year one, how is the liability allocated, and what's the outside basis of the partner in that year? You take their 705 normal basis that you calculate, and you add on the liability that's allocated to them to calculate their end outside basis. So that's what you're doing each year. All right. So remember, Section 752 is where you go to find the specific rules for liabilities. Now, we know that in partnership tax, subchapter K, the 700s, it's very small, and that you got to rely heavily on the regulations. Same thing for this topic. Now, liabilities are broken into two topics. Well, specifically, they're broken into two types of liabilities, I should say. There's what we call a Reg 1.752-1 liability, and there's a Reg 1.752-7 liability. Now, I'm going to go ahead and I'm going to distinguish these two liabilities and tell you that one of them we're not going to focus on in this discussion because it's beyond the scope and there's special rules. So the Reg 1.752-7 on the right side, this is for contingent liabilities, like environmental potential liabilities. Like, okay, if you are BP Oil and there's a potential environmental liability out there if there's an oil spill, you got to put it on the books, got to record it in the footnotes, the financial statements, whatever it is. It's still a liability. Well, how do you allocate that when you got contingencies or maybe potential lawsuits, stuff like that? Those are contingent liabilities. We are not going to focus on that. Those have special rules, very advanced rules. The topic we're already dealing with is an advanced topic, but those even have more advanced rules. So we are focusing on just plain liabilities that are not contingent. We call those Reg 1.752-1 liabilities. So for purposes of this analysis, all liabilities, and liabilities are what a business or person or entity, whatever you want to think of, it owes someone outside the business or someone that's within the business but not in a business, an ownership manner, right? That's a liability. So any liabilities that are not contingent on any events or any specific ideas, those are Reg 1.752-1. Now, the way the tax law and the regulations, it determines how we break up those liabilities. We ask the question, who bears the economic risk of loss? Who bears the economic risk of loss? And the economic risk of loss idea is similar to Reg 1.704-1-2-3 and the idea of substantial economic effect. It's not identical, but it's similar. So who bears the economic risk of loss? That's the question we ask. That's a central question. If you're doing an exam problem, somewhere, even multiple times, you want to put down who bears the economic risk of loss. That is the heart and the focus of the 752 regs. All right? Now, the regs, they make a difference between two different types of liabilities. And you've probably heard about these before. There's recourse liabilities and there's non-recourse liabilities. The way I like to describe recourse and non-recourse at a very basic level, and I know I'm assuming a few things here, but at a very basic level is I like to think of it like unlimited versus limited liability when you talk about limited partnerships and general partnerships. Similar idea. With the recourse liability, someone or multiple people, they are pretty much unlimited liable for the liability. They can go out of pocket the whole way. That's recourse. Non-recourse liability, no one has unlimited liability. They might have some limited liability with respect to the liability, so they might have to contribute something or up to a certain amount, but not unlimited. That's the way I distinguish. And the regs, they do something similar, but in a different way. They focus on economic risk of loss. Now, the regs for recourse liabilities are found in Reg 1.752-2, and non-recourse, let me put that 2 a little bit clearer, sorry. And the non-recourse are found in Reg 1.752-3. And we're going to talk about a few things. First, we're going to talk about some specific issues that come up with determining, okay, well, who bears the economic risk of loss? And what exactly should we focus on? So in the middle, between these two, I've got some principles and some ideas you should always focus on, especially if you're doing exam or in practice, that make things a little bit more challenging, and then we have some special rules for them found in the regs. So the first thing that we are going to look at when it comes to who bears the economic risk of loss, and as I mentioned earlier, this is an idea similar to the 704 regs, is we focus on the partnership agreement. Just like most things in partnership tax, we focus on the partnership agreement. The idea, remember, is Congress intended flexibility, extreme flexibility. They wanted businesses to conduct business and not be stifled from business. We're going to focus on the partnership agreement. So the partnership agreement specifies that the liability is going to be absorbed some certain way. Someone is responsible, some partner or another partner or some specific agreement. We're going to follow that. So we need to focus on what is in the partnership agreement. Profit-loss ratios, capital ratios, maybe with specific side agreements with respect to the liability. We focus on what's in the partnership agreement. The second thing we have to understand is local law. And this goes back to the idea I just mentioned about how to recourse and non-recourse liability with limited and unlimited liability. That's why I like to discuss it like that. Local law still is very important. The idea here is you'll see with a lot of the analysis we're going to focus on for recourse and non-recourse liability, what happens at the end of the day? when the partnership winds up hypothetically. Well, under local law, as we know, general partners versus limited partners don't have to, they're not unlimited liability. They don't have unlimited deficit restoration obligations like general partners do under local law. So that's going to affect how things are viewed. And that's going to affect our analysis that we're going to do. So keep that in mind. Local law is still essential. Okay? Local law is still extremely important. All right. The next thing, so far, a lot of what we talked about already is stuff that we've already seen elsewhere in partnership tax. So it's keeping in line with the substantial economic effects, 704, non-recourse deductions. We've done this already, right? A lot of our friends are back to visit us. So the next item is something new. This is where we start getting specifically into liabilities. The next concept is very important. It's very important and it makes this topic a lot easier. There's basically some assumptions that Congress has given us, Treasury has given us, that we can assume that help us significantly. The next one is what we call the satisfaction presumption. The satisfaction presumption. Now, within the satisfaction presumption, we've got 3 sub-issues, and they deal with guarantees of loans, indemnification of loans, and also pledges. Here's the idea. It's possible, it happens all the time in practice, where partnership takes on a liability, whether it's recourse or non-recourse by title, hold that aside, but maybe a specific partner is going to guarantee a loan. So that way, if the partnership goes belly up and can't pay it off, the partner has guaranteed it, so it's like a second level, it will go to that partner. Or indemnification, which means that under local law, that's the idea of indemnification, the partner that indemnifies other partners, if the other partners go out of pocket, that partner has to reimburse the other partners. That's indemnification. Or pledging. Maybe a partner is going to pledge property, securities, whatever, with respect to a guarantee or up to the extent of the loan if the partnership doesn't pay. So the satisfaction presumption assumes that if a liability, for example, is considered recourse, that all the parties, they're going to make up. They're going to actually go through and pay it off. So the satisfaction presumption states that economically, the parties will make good. Because the idea is this. As we're going through, we're allocating the liabilities each year, including the initial on formation or on the taking out of the liability, we have to think about what happens if X partner would default and they wouldn't pay off the liability? Yes, they would go to court and all that good stuff, but maybe they go bankrupt. So there's a lot of what ifs that we could go down, these lines and say, okay, well then the guarantee now becomes important, because if that partner X is not going to make good full faith and actually pay off the liability, now partner Y that's guaranteeing is now responsible. Well, that's all hypothetical. We don't have a crystal ball. We don't know what's going on. So Treasury, IRS, the regulation says, you know what? We're going to assume that in most cases, specifically recourse liabilities, that the partners they're going to make good faith. They're going to pay everything off. We're not going to assume that the guarantee is going to pop up. However, it's non-recourse that can change. So when it comes to guarantees, it depends on the fact pattern. If it's recourse versus non-recourse, makes a big difference. I have some problems in later video that you should go through and look through these issues. But it depends on the situation. If it's a recourse liability and someone guarantees, the guarantee is going to pretty much be ignored. Unless, if it's non-recourse, then now the guarantee becomes very important. Now, there's something called a bottom dollar guarantee, which basically what a bottom dollar guarantee, an example would be let's say a liability is $5 million and someone says, you know what, I'll guarantee the last $1 million. A lot of times in tax law, those are ignored for regardless of the situation. There's a few times where it doesn't happen, but generally speaking, bottom dollar guarantees are pretty much ignored. They're either all or nothing type ideas. Indemnification, I mentioned that earlier. That's where a partner is going to basically reimburse other partners for the loan they have to take on. And pledges is when you use property basically as a collateral on the actual liability in case the partnership or partners don't pay it off. Now, if pledges, we always use the fair market value of the respective amount, not the adjusted basis, so keep that in mind. So keep in mind those ideas. Again, we focus on the partnership agreement, how things are going to be allocated, profits, losses, any side agreements going on, guarantees. So focus on what's in the partnership agreement. That's by far the most important. That is, of course, the heart of this topic is the partnership agreement. We also look at local law. If we don't have something in the partnership agreement, right? If you're a general versus limited partner, go to local law. Finally, if you do have stuff like guarantees and indemnification and pledges, just keep in mind the idea that satisfaction presumption, that the partners indeed will make good even though we don't know because we don't have a crystal ball to see what happens in the future. We're trying to allocate liabilities, and we're doing so in hypothetical situations, so we're going to assume, that the person's actually going to pay it off. So going through that analysis, recourse liability, because the question again is who bears the economic risk of loss? A recourse liability is any liability where somebody in the partnership bears the economic risk of loss. Someone or multiple people. Or it could be the partnership itself. It could be recourse to the partnership itself, and you have to allocate according to the partnership agreement. So recourse liability, somebody has economic risk of loss. Now, when there is a recourse liability, so when you're doing this analysis, you're going to be given a liability, and it's not always clear if it's recourse or non-recourse. Maybe it's not stated. But you do have a lot of information given to you. Can you make that determination depending on ultimately what happens? Recourse versus non-recourse. If it's recourse, the next question is who is it recourse to? Because that's going to go into their basis. Because the way that recourse liabilities are allocated is in accordance with the economic risk of loss principles, who bears what. Now that sounds a lot more conceptual than it is. So what Treasury did is under Reg 1.752-2, and it's throughout that reg, so you can just cite to Reg 1.752-2, there's what we call the hypothetical liquidation or end of world constructive liquidation test to see how things play out. This is a 5-step test. And of course, it's hypothetical, it doesn't really happen, but you assume these 5 things for recourse liabilities to determine how they're actually broken up. The first step is that all liabilities of the partnership are due and payable in full to the respective lenders. Are due and payable in full. So you take the face amount of the liability at that time, and all liabilities are due and payable in full to the lender. Then we go to the second step. The second step is that, all the assets of the partnership are now worth 0. They're worthless. So all assets of the partnership are worthless. The third step, all assets are disposed for $0 because they're worthless. So all the assets are now disposed. So the partnership is not going to have anything. All assets are disposed of for $0. The fourth step, you then go through the analysis like we've done back in the substantial economic effects 704 regs and the non-recourse deduction and the 704C. You go through and you allocate out the gains and losses according to the partnership agreement. So we're going to allocate. So the partnership allocates all items of income, gain, loss, deduction as of the last day on that hypothetical event. And that last day is the day you're trying to determine, how liability should be allocated. So that could be on formation of the business when the liability is taken out. It could be the end of the year, whatever it is. And the fifth step is the partnership is indeed going to liquidate. Again, this is all hypothetical. It does not actually occur. We're doing this so that we can then determine, of this recourse liability, who is responsible for what? Who is responsible for what? That economic risk of loss idea? Who is responsible for what? And then you're going to give out the liability through basis to those partners in that specific way you've determined. Who's responsible for what? So the idea there is if you have a general partner or limited partner, you have a recourse liability, well maybe the limited partner can only go to zero in their capital account, and then the general partner now goes negative, but they can go unlimited. So that's the idea. So you got to think back to what you learned back in 704. It's that same principles of the capital accounts. And that's the one thing you got to do, is you got to do capital account analysis for all this stuff. It's back to capital account analysis. You're doing all this analysis. So that's recourse liabilities. Again, I have some videos that walk you through these steps. So keep that in mind. Let's talk about non-recourse. So non-recourse, nobody bears economic risk of loss. Nobody bears economic risk of loss. No one. Or the partnership, nobody. Now on the exam questions, a lot of times you'll be told what kind of liability it is, but there might be side agreements that could change it. So especially with non-recourse liabilities, those things, those three items we talked about, you got to be really careful. So what I'm saying is that a liability might be claimed to be non-recourse, but then one partner might guarantee it, and now boom, it's a recourse with respect to that partner. That's called a non-recourse liability with respect to a partner. But that partner, so it's non-recourse to the partnership, but to the partner it's going to be considered recourse. So if we have a non-recourse liability, if it's recourse, it's recourse. You do that analysis. The partner that bears the economic risk, you allocate to him or her, or it if it's an entity. But if you go through and you say, well, nobody bears economic risk, even looking at the side agreements and all that good stuff, all those three items, then non-recourse liability, we've got to allocate according to three things in Reg 1.752-3. Now, this one is an order. You allocate in this order, always in this order. So what I'm saying is, let's say we have $1 million of non-recourse liability. This is a waterfall test. You go down in order if it meets it. If it doesn't, you go to the next step. And the next step, and whatever's left, will go to step 3. But if everything is in step 1, boom, you allocate it that way. So the first step is to allocate the non-recourse liability, which in our example I said is $1 million, based on how the partnership minimum gain, the PMG, right? Partnership minimum gain. We learned that back in Reg 1.704-2. We talk about non-recourse deductions. How partnership minimum gain, also known as Tufts gain, is allocated between or among the partners. So however the partners break that up, that $1 million will go in that order. If there is any PMG, there might not be any PMG. There might not be enough. We might have $1 million of non-recourse liability. There might only be $400,000 of PMG that year. But remember, we're doing this each year. So next year, so this year might be $400,000 of PMG. We allocate step 1 according to how we share the PMG. But next year, it might be $600,000 of PMG. So that's how you see this can change each year. The liability allocation can change. So first thing is how the PMG is allocated among the partners. The second is how 704C, pre-contribution gain, that's, we talked about this, specifically gain, not loss, pre-contribution gain is allocated to a specific partner. We talked about this in Reg 1.704-3, pre-contribution gain. Now the way you calculate this is you take the liability amounts as of that date, the face value, minus the adjusted basis of the property. Idea is if the property was to be taken, because remember, non-recourse liabilities, the general idea is that if a lender lends on non-recourse basis, you better believe they're going to attach it to property. So that's what we're talking about, the property itself, that pre-contribution property. So we're saying there's a building where someone contributes it to the partnership and there's a liability on it, it's got built-in gain. You're going to take the liability minus the adjusted basis. And you're going to allocate to that partner, that contributing partner, the CP, in that order, the contributing partner. Finally, if let's say we have nothing. Let's say we have our $1 million non-recourse liability. We have got no PMG because our liability amount, our adjusted basis is greater than or equal to the liability amount for the year. So we've got no PMG. We've also got no 704C pre-contribution gain because let's say that we started off the partnership with the owners just contributing cash. The partnership borrowed a non-recourse liability and then bought property. So that would be no PMG, or no 704C pre-contribution gain. So then the third part of the waterfall, which always works, is called the excess non-recourse liabilities. It's whatever's left over. The excess non-recourse liabilities. So it's whatever's left. Excess non-recourse liabilities. There's 3 different ways to allocate excess non-recourse liabilities. And any of these 3 ways can work. It's all about what's in the partnership agreement or what's not in the partnership agreement. So the first way is based on profit ratio. Now, at one time, the rule was this simple. Non-recourse liabilities were allocated using profit ratios, and recourse liabilities were allocated using loss ratios. That's how it was in the past. Today, that general rule a lot of times still applies. Because if you look at these rules, well, hypothetical liquidation, when everything was worth 0, that's a loss situation. So for recourse, that's why you use loss ratios. And then for non-recourse, profit ratios, because the idea is that if the business is doing well, it's more likely to pay off the liability. If it does bad, goes belly up, guess what? They're going to walk away. They're going from the liability and the property, and the lender takes on the risk. So profit ratio is the default rule. If the partnership agreement specifies profit ratio, you use the profit ratio. If it does not specify any of these, you use the profit ratio. That's what I mean by default. If it's silent, you use this, or if it specifically says so. So that's why it's the default rule. Now, one thing I want to note, I'm not going to write this one down, but when it comes to this profit ratio, it has to be a profit ratio that meets substantial economic effect rules. It has to follow that criteria. That's usually almost never an issue when you get to this point, though, with a non-recourse liability. It usually does not. It's very rare for this to be not respected for SCE at this point. The second way that we can allocate is using the NRD deductions, the NRD ratio. The NRD ratio. Now, that's assuming if the NRD, which remember, we talked about NRDs in Reg 1.704-2, there's a reasonable consistency in all the rules with the minimum gain chargeback. So that's only if it meets Reg 1.704-2. Again, you got to specify, though, in the partnership agreement that you're going to use the NRD ratios, not the profit ratio. If you don't specify, you're going to use the profit ratio. Finally, the last one is called the additional method. This is very rare. This one is very rare. This one continues on with our 704C analysis. And what it does is it allocates the remaining excess to the contributing partner, the CP, the contributing partner. We take the amount of any 704C gain minus the minimum 704C gain. Now this one again it's a little confusing. I'm just going to explain it as that. That's a special rule, and you have to put that one in the partnership agreement. All right, so that gives us the basics of how to allocate recourse and non-recourse and what things to pay attention to. Again, I've got some videos with some problems where I use this same approach. So please look at those problems because with this topic, it really does help a lot to go through the problems.